Let's talk about the stormy weather that's been happening over the past few years, and you have devised something that hopefully will help us cope in these stormy times, called safe harbour planning, which to me seems quite obvious in as much as when it's pretty nasty out there, you find a nice little safe harbour and go and sit in there for a bit, which might not be the best plan, I don't know.
Well, what we try to do is develop a strategy for clients that would give them greater reassurance and confidence, because the last few years, let's face it, haven't been very good. And I think the main focus of this strategy is to be a lot more proactive. Right. Because if you look back at most stock markets over the last 10 years, the traditional way of investing was that you buy something and you hold on to it. And so if you'd have done that over the last 10 years, and you look at your money now, you wouldn't have actually made any money, because bizarrely the stock market today, September 2011, is lower than it was 10 years ago. And I think what we're trying to do is sort of re-educate people and say, well, actually, there's another way of running your money, which is to be a little bit more proactive, to actually, follow certain trends when things are doing quite well, and actually pop into the harbour when things aren't doing so well. Because my view is that, the qualities of a good sort of money manager are not so much when things are going really well, because you could say, well, if confidence is high, everything's going to do well. But it's more in protecting people on the downside, because the traditional way of investing, and what the wider industry would say, is that if the stock market goes down, do nothing, sit tight, stay where you are. And this leads to a problem that literally thousands of people are stuck in underperforming funds, not knowing what to do, because really the industry is giving them the wrong signals.
So when you refer to safe harbour planning, first of all, I'm still allowed to go in there occasionally, aren't I, and be safe from the stormy weather. So exactly how does that work? What will you then be doing for us?
What's really important, and what we do that's a little different, is we really concentrate on what we call stress testing. So we've got some fantastic data over the last few years of looking at investment funds and saying, well, okay, when that fund was really stress tested, in 2008, 2009, it doesn't matter how good the fund manager, doesn't matter how good the hype is surrounding the company, we're really looking at what happened to that fund in real time, in reality, how did it actually work? And we're looking at funds that have a slightly different correlation, and that's a kind of a strange word, but what I really mean by that is saying, well, look, if the share market's falling, what else is out there that either stays the same or might go up? And you may have heard, certainly in the news over the last few years, about safe havens and things like that. And what does that mean? Well, it means that you're investing in things such as treasuries, gilts, fixed interest, index-linked gilts, some sort of defensive managed funds, that sort of thing. And so if you blend those into portfolios, you don't get such a shock when the stock markets fall. So not only are we talking about safe harbour planning in the context of being proactive and actually taking profits when they're there and parking them, but also in saying, well, okay, if we are going to be in certain other types of funds, we want to be in those funds that if the market falls, we don't lose our shirt. And I think there's a great misconception that, if the stock market falls, you can do nothing about it. Well, maybe you can't actually at that precise time, but I take the view that there's always going to be stock market volatility, so why don't you plan in advance for it? Now, we're not for 1 minute saying that everybody should panic sell or anything like that, but what we are saying is that when the market goes down, and your money might go down, it should be reviewed. Don't just stick your head in the sand, don't just do nothing. Yes, it's a natural sort of psychological thing to sort of think, oh my goodness, I've lost 5 or 10% of my money, I'm not going to do anything until the markets go back up. But really, that's what the financial industry wants you to do, because they don't want you to move out of all these rubbish funds. Now, I'm using quite sort of interesting phrases there. There was actually an article in the Financial Times last Saturday.
What, about rubbish funds?
Well, actually, they were worse. They actually referred to them as dog funds or zombie funds. And what they were saying was that over the last 3 years, 74% of funds have underperformed their benchmark by 10% or more. Right. So 3/4 of the investment funds that you and I can go into over the last 3 years have underperformed. And they equated that to there's approximately £23 billion in funds today that actually are in funds that aren't doing very well.
But a lot of people wouldn't know that, would they,
Not
necessarily?
unless, going back to the money labelling thing, they look at what's inside their money and they review it. And I think this is the biggest thing that's changed in the last few years, because it used to be that you buy something, you hold on to it, you don't really look at it. It now has to completely change, that you monitor everything, or we do it for you, and you blend different ingredients into your portfolio to help protect the profits that you're making and help safeguard your assets, because as eggs are eggs, there are going to be times when really, out of the blue, markets are going to fall.